Welcome back to Wealthway. Today, we're diving into the fascinating world of debt, exploring how it can be a powerful tool in the hands of the wealthy. Debt is often seen as a risky endeavor, but as we'll see, it can also be a double-edged sword that propels dreams and fortunes. In this video, we'll uncover the strategies used by the rich to leverage debt for financial success. Let's get started. John D. Rockefeller, a farmer's son and high school dropout, embarked on a journey that would reshape history. His insatiable thirst for knowledge led him down a path where school might not have taught about money, but real-world experience would become his ultimate teacher. As destiny would have it, Rockefeller landed a job as an assistant bookkeeper, providing him an invaluable backstage pass to the intricate world of business. Fueled by his vision, he recognized the potential for immense wealth. But he needed a spark to ignite that vision. That spark came in the form of debt, a mere $1,000 loan from his father. Armed with this modest sum, Rockefeller ventured into the realm of business, founding a small agricultural commodity trading enterprise. This initial debt transformed him from an observer into an active player, gaining him a strong foothold in the business landscape. The early years saw him reaping profits, with his earnings reaching an impressive $17,000 within just 2 years. But it wasn't just about profits. Rockefeller's innovative thinking set him apart. In an era when kerosene extraction from coal was cumbersome and expensive, he introduced gasoline as an alternative. This simple yet revolutionary move slashed costs and boosted efficiency, capturing the attention and trust of bankers and lenders. With their newfound trust, lenders extended more favorable terms to Rockefeller, and that's when the tide shifted. Utilizing that strategically, he seized opportunities, acquiring smaller competitors and crafting an oil monopoly. This powerful monopoly enabled him to secure volume discounts from railroads, revolutionizing transportation costs and making kerosene accessible even to low-income households. By his early 30s, the once farmer's son stood tall as a millionaire, refining a staggering 90% of the nation's oil supply. Rockefeller's journey is a testament to the intricate dance of debt and opportunity. He harnessed debt not merely as a tool, but as a catalyst for growth, transforming a borrowed $1,000 into an empire worth billions in today's dollars. Ever wondered how the ultra-rich sustain their lavish lifestyles? Beyond the glitz mansions and luxurious getaways lies a lesser-known truth. They don't rely on salaries. Let's uncover the intriguing financial strategy adopted by the likes of Elon Musk. While we often marvel at their opulent lifestyles, a surprising revelation surfaces. The wealthy rarely fund their extravagance through traditional earnings. In a 2021 tweet, Elon Musk lifted the curtain on this well-guarded secret. Musk, the iconic entrepreneur, forgoes a conventional salary. His wealth is anchored in Tesla stocks worth billions, yet he doesn't liquidate them for expenditures. Instead, he employs a clever maneuver, borrowing against his stock value to access funds. This financial alchemy brings Musk double benefits. First, it steers him clear of hefty taxes. Borrowed money isn't taxable income, allowing him to indulge without diminishing his funds. Second, he sidesteps capital gain taxes by refraining from selling his Tesla shares. Musk's secret sauce lies in leveraging his stocks as collateral for loans. This creative approach, often termed an evergreen line of credit, lets him access funds without liquidating his assets. Let's say he secures a loan at a 6% interest rate. The stipulation: Tesla must grow by at least 6% to repay the debt. he secures another loan against the same stock, forming a self-sustaining cycle. Through ingenious financial engineering, Musk lives a life that many can only dream of. His borrowed wealth fuels his aspirations, all while preserving his valuable stock assets. This unconventional yet effective approach offers us a glimpse into the world of financial possibilities beyond the ordinary. Ever wondered how the rich seem to effortlessly navigate the world of real estate? Prepare to be amazed by their game-changing tactics that set them apart from the average person. While most of us struggle with a single house mortgage, the wealthy take real estate to a whole new level. They borrow to acquire multiple properties worldwide, a surprising twist being that they don't even reside in most of them. Even more astonishing, they borrow money for properties worth millions, despite their billion-dollar net worth. Take Elon Musk, for instance, who borrowed $61 million for 5 California houses in 2018, even though he could have easily paid up front. But what's the missing piece of this puzzle for the average person? While we typically borrow when we can't afford something outright, the rich borrow even when they have the means to pay up front. Why, you might ask? The answer lies in the magic equation. Debt equals no taxes. Imagine finding $1 million property. Borrow 80% from the bank and raise the remaining 20% from investors. Say your annual debt repayment is $100,000 and property maintenance costs total $20,000. Renting the property for $140,000 not only covers your expenses but leaves you with an additional $20,000 profit. Here's the real twist. This income is tax-free. Why? Because you're allowed to account for depreciation, an assumed wear and tear cost on the property. In this example, a common real estate depreciation rate of 139 grants you a yearly depreciation of $25,641. As this depreciation exceeds your $20,000 income, you can claim a tax loss of $5,641, all while having $20,000 in your bank account. The richest real estate strategy not only redefines how they invest but also how they leverage tax benefits to amplify their wealth. It's a game changer that transforms properties into income streams and investments into tax-efficient endeavors. Still with us? Comment "mansion" so I know you've reached this portion. Brace yourselves for a masterclass in financial strategy. When it comes to the rich, there's a method to their financial decisions that's nothing short of genius. Consider this. Elon Musk, with a net worth nearing $250 billion, borrowed a whopping $13 billion to acquire Twitter. Seems counterintuitive, right? But there's a method to this madness, and it's called a leveraged buyout, or LBO. In an LBO, borrowed funds are secured against the assets of the acquired company. For Musk, Twitter was the target. This strategic maneuver involves lenders betting on the acquired company's profitability, with its future cash flows paying off the debt. But there's more to this puzzle than meets the eye. Musk's motivation goes beyond profits. He envisions Twitter as a force for social change and free speech. His calculated risk demonstrates his confidence in the platform's potential, even as he acknowledges its uncertainty. Here's the kicker. An LBO limits Musk's risk. If Twitter prospers, he reaps significant benefits. If it falters, his exposure is confined to the equity he holds. Lenders can't hold him personally accountable, only recovering their investment by selling Twitter's assets. As time unfolds, we'll see whether Twitter's assets cover the debt or not. Yet Musk's strategic borrowing isn't just about this acquisition. It's a shield for his personal assets and maintains the autonomy of his various ventures. This calculated move epitomizes the rich's art of generating liquidity, growth, and security. Get ready to unravel a key principle in the wealth accumulation playbook. The rich aren't just about acquiring assets. They've mastered the art of generating liquidity to seize golden opportunities. Imagine holding assets that appreciate over time, destined to be passed down for generations. The rich understand this and prioritize safeguarding their family's future over the quest for a debt-free existence. Yet, this doesn't mean they miss out on multi-billion-dollar opportunities. Even with significant funds tied up in less liquid assets, they ingeniously generate liquidity through debt to capitalize on lucrative ventures. A prime example is Mukesh Ambani, chairman of Reliance Industries, who, in April 2023, secured a staggering $5.5 billion loan for a nationwide 5G rollout in India, a move that might seem surprising given his immense net worth of $82 billion. Ambani's $2 billion Antilla mansion and numerous global properties could have easily financed the 5G project. However, he's looking beyond immediate funds. He's focused on leaving a lasting legacy for his 3 children, Akash, Anand, and Asha. Ambani's vision isn't just a pipe dream. A 5G revolution could contribute $180 billion to India's economy by 2030, potentially powering 2% of its GDP. He's not about to let this transformative opportunity slip away. It's a testament to strategic thinking, preferring borrowed liquidity over missed market share. Ambani's willingness to borrow today for a more prosperous tomorrow showcases a financial mindset that's anything but ordinary. Brace yourselves for another glimpse into the financial wizardry of the wealthy. In 2012, Mark Zuckerberg orchestrated a move that demonstrates their unparalleled knack for leveraging debt. Picture this. In a world where average mortgage rates hovered around 2.7 to 6%, Zuckerberg secured a jaw-dropping 1.05% interest rate for his house mortgage. The question is, how did he pull off such a feat? The answer lies in his colossal net worth of $15.6 billion at the time. Bankers had no doubts about his ability to repay, significantly lowering the risk. This trust allowed them to slash the interest rate, an advantage often granted to those with high net worth or exceptional credit scores. Beyond a favorable rate, Zuckerberg's move unveiled a multi-pronged strategy. Firstly, he instantly secured his dream house, where he'll continue to reside at his leisure. Secondly, he strategically allocated his funds into more lucrative investments, generating substantial profits, even after accounting for the mortgage interest. Here's where Zuckerberg's foresight truly shines. By spreading his mortgage payments across 30 years, he harnessed the power of inflation. As time progresses, the real value of these payments diminishes, effectively reducing his expenses in inflation-adjusted terms. Zuckerberg's calculated decision wasn't just about acquiring a house. It encapsulated a multi-layered strategy. He seized investment opportunities, leveraged his net worth for favorable terms, and optimized the impact of inflation. So there you have it, a closer look at how the wealthy wield debt as a powerful tool for building fortunes, making strategic investments, and securing their legacy. Debt, when used strategically, can indeed be a double-edged sword that turns dreams into reality. If you found this video insightful, don't forget to like, share, and subscribe for more valuable financial insights. Until next time, stay financially savvy!